What's going on, you guys? My name is Zach Hartley, and in this video I want to show you two different strategies for how to make money when stocks are going down and the market is crashing. Here's everything you need to know. Let's go. Okay, so the two strategies I want to walk you through today are number one, shorting a stock, and number two, buying a put. Now the first strategy here, shorting a stock, is very simple. All you need is a margin account. Now I personally use Questrade, and that's where all the screenshots are going to come from today. There's a link down below for Questrade if you want to check it out, but you will need a margin account. So that's step number one. Step number two is to get your order ready, and then you want to click the sell button to open the trade. That is how you start shorting a stock. And then when you want to close that trade and you want to get out of that position, you click the buy button to close that trade. Now what this is going to allow you to do is, let's say that you get into Apple at $150 and it drops down to $100. This allows you to make that $50 profit when the stock goes down. That's what happens when you short a stock, and the actual orders are really easy. It's exactly what I just explained to you. Sell and buy buttons, they're just kind of in reverse orders there, but what happens behind the scenes is a little bit more complex, and I want to explain it to you just so that you can understand it. So when you sell to open on a trade, or when you short a stock, that's what you would go through. What's happening behind the scenes is that you're actually borrowing those shares from the broker. So for me, it's Questrade. I'm borrowing those shares from Questrade and I'm selling them in the market, and I am collecting that cash. Then if the shares go down in value, let's say they go from 150 to 100, I can use that cash to buy those shares back and return those shares to Questrade. That way, I'm even with Questrade, and the only difference has been selling at 150 and buying back at 100, and I'm allowed to keep that $50 profit. And that's how you make money when stocks go down. And so that's what's happening behind the scenes here, and it basically allows you to make money when stocks go down. Now, what you need to know about shorting stocks is you need to understand the risk to reward ratio. So let's say that we're shorting Apple at $150. Well, if Apple then goes to $0, that means that we don't even have to return any shares to the broker, and we would make 100% of our money because those shares are now worthless and they've gone from $150 to $0, and we make all of that money going down. The problem with shorting a stock, though, is that if the stock goes up in value, you can lose money. So that's how you lose money on the trade. Just like in a regular trade, you would lose money if you were long on a position, you would lose money if the stock went down. Well, when you short a stock, you will lose money if the stock goes up. And unfortunately, there's no limit to how high a stock can go. So if you buy Apple at 150, theoretically, it could go to $250, $350, $450, $1,000, $5,000 overnight, and you would have to go back into the market, buy those shares back, and return them to Questrade. And that means that you could actually lose more money than you had invested, and that's what's referred to as unlimited risk. And so if the stock goes up in value, you have unlimited risk because there's no limit with regards to how high that stock can go, but there is a limit with regards to how low that stock can go. It can only go to zero. It cannot go to -1. The stock value can only go to zero. So in a regular trade, when you buy a stock, the maximum amount of money that you can lose is the amount of money that you invested. But when you short a stock, you can actually owe more money than you invested, and that's something that you need to be well aware of. Now, to get around that, you do have some other options out there, and that's why I'm giving you two strategies. And so the second strategy here is to buy a put option. Now, a put option allows you to sell a stock at a specified price. And the advantage of a put option over shorting a stock is that it has a maximum downside of 100%, meaning that you can only lose the amount of money that you're putting in. You can never owe money when you're buying a put option, and you also don't need margin in order to buy a put option. So there's a lot of great advantages to buying a put option, and this is usually the strategy that I use, but you do need to understand shorting a stock anyways, so that's why I explained it. So buying a put option, let's just look at an example here. So you buy a put option to sell Apple stock at $150 on February 18th, 2022. So that means that I'm going into the market and I'm buying this option, and it gives me the right to sell Apple stock at $150 on February 18th, 2022. And it basically means that no matter what, there's going to be somebody on the other side of that trade that will buy the Apple stock from me at $150. That's what it's saying here. Now, if Apple stock falls to $100, that means that Apple stock is now at $100 at the market price, but I'm allowed to sell it at $150 on February 18th. So what I can do here is I can go into the market and I can buy the stock at $100 at the market price, and then on February 18th I can sell it for $150 and I can make $50 per share. So you can make money buying put options if the price of the shares goes down. Now, when it comes to options, there's a little bit of terminology that you need to know. So the first piece of terminology is called the strike price. This is the price at which you can buy or sell the shares. Now, the next piece of terminology here is called the expiration date, and this is basically the date that your options must be converted on. So for us, it was February 18th, 2022. That is the date that the options expire on. However, you can buy and sell the options prior to that expiration or before that expiration. And if it looks like those options are going to be more valuable, those options can fluctuate drastically in price. And so you can actually day trade or swing trade the options. You are not required to hold those options until expiration, but expiration is the day that those options can be bought or sold for the actual shares. Now, the premium here is something that I skipped over in the last slide because it's a little complicated, but the premium is the price that you pay for the option. And so I'm gonna have to go into the market and buy that option. And that act of buying the option is gonna cost me some money, and the money that it cost is referred to here as the premium. Now, the last piece of terminology that's not on the PowerPoint here that you need to know is something called a contract. A contract represents 100 options, kind of like a dozen eggs represents 12 eggs. A contract represents 100 options, and options are only sold in contract. So what that means is that if you want to buy the put option to sell Apple on February 18th, 2022 at $150, you're going to have to pay the premium for that option, but you're going to have to multiply it by 100 because those options are only available in contracts. And so if it costs me $2 to buy this premium right here for this put option, it would actually cost me $200 because the minimum amount of options that I could buy is 100 options, because the minimum that I can buy is one contract, and that represents 100 options. Okay, now what I want to do is show you a real life example on Questrade of me buying a put option as well as shorting a stock, just so that you can see exactly what it looks like and that there's no confusions. If you want to check out Questrade for yourself, there's a link down below that'll give you $50 in free commissions, and there's also a link down below that will give you $25 in completely free crypto when you deposit $100 on Newton. So I promise you, it's like a 25% instant return. It's well worth your time. But let's jump into the example. Okay, so this is what the Apple chart looks like. As you can see, they're trading at $173 right now, and it's currently at a pretty nice run up over the last sort of month. I'm looking at a daily candlestick chart right now, but it is pulling back over the last 3 days here. So we are gonna short the stock right now. I'm gonna short it for one stock. It's gonna be a market order. It's gonna be a day duration here. I'm gonna leave the route at auto, and I'm gonna make sure I'm using my margin account. I'm gonna click on the sell button here. It's gonna ask me to confirm that I'm creating a short position, and then I'm going to send that order. And as you can see, that order is now placed. So I am currently shorting Apple stock, and if it goes down over time, we are gonna make some money. I'm gonna zoom into the 1 minute chart right here, and we are going to see what it looks like. So as of right now, I'm probably losing a little bit of money, but we are in it. It looks like we're actually going up here. So what I'm gonna do is I'm gonna actually close out this position, and in order to close out that position, I'm just gonna click on the buy button right here. I'm gonna click on the send order button, and now it has closed out my position. I've got my account summary on the other page here, and it now shows that my open quantity and my current quantity is 0. So I have now shorted the stock and then covered that position. That's how easy it is to short the stock. You just need to make sure you're in a margin account. Okay, now let's say that we want to buy put options. What we're going to do is go to the left hand side here. I'm going to change this from stock to options. And then as you can see, we've got some different variables right here. The first one is the date. So I'm going to change this to February 18th, just like we used in our example. And we are going to put it to, let's call it $150. And instead of buying a call, we actually want to buy a put. And we don't need to look at this on the 1 month chart. We're gonna look at it on the 6 month chart. And so here you go, you can actually see what the price has done over time. So as the stock has gone up, the put options have gone down, because like I said, we are trying to make money when the stock goes down, and obviously if the stock goes up, we are gonna lose money. However, over the last 3 days, as you can see here, the put options have actually gone up in value from about $1.50 to $2.50 right now. So there's actually some pretty good momentum here over the last few days. Let's see if we can zoom in just a little bit here to the 5-day 1 hour chart. And as you can see, we bounced off 150, we got to as high as $2.65. So we're making some good momentum. Now, for me to buy these, the first thing I want to do is make sure that my order windows are linked up. And on Questrade, it's like this paper clip right here. You just want to make sure that they're the same color. And that means that they are basically linked up so that when I change the different options here on the chart, it will give me the exact same options in the order window here, which is really, really nice. So as you can see, we're doing Apple options. That's what OPT means right here. 18th of February, 2022 expiry, $150, and we are buying the put. We are gonna buy just one of them. We're gonna buy it at the market price right now because the spread is pretty close. We're gonna leave it as the day duration, make sure we are using our margin account again, and then we are going to make sure that we are buying the put. We wanna make sure that we are buying it and not selling the put, because that's gonna open up a different type of order. We're gonna send that order, and now as you can see, we have that order there, and it actually cost me, let's just see how much the total trade cost me here. So the total trade cost me $249, and again, remember, I got in at, let's call it $2.49 here, but it cost me 100 times that because I had to buy one contract, which represents 100 options. And so definitely something to keep in mind here. That is not something that you want to mess up, especially when you're trading options. And now, if Apple continues to fall in price, these options should go up over time. And like I said before, I can buy or sell more or less of these options at any point up until expiry. But on the expiry date, they will have to be converted into shares if they're in the money and profitable. Okay, so now to get out of these options, all I'm gonna do here is click on the sell button, and that is going to exit my position here. I clicked on confirm, and as you can see, it is sell to close, one Apple, 18th of February 2022 at 150 put at market. So that's my order that I just placed. I have now shorted and covered my position in Apple stock, and I have bought and sold a put option in Apple right in front of you guys. So if you get any value out of this video, remember to click that like and subscribe button. Now, if you're interested in learning a little bit more about how to analyze stocks and make trades like this, then definitely consider signing up for my completely free Stock Market Fundamentals course. It has over 10,000 students, over 1.5 million minutes of watch time, and there's 340 reviews for you to take a read through, and it's completely free for 2 weeks when you sign up with the link down below and cancel your subscription in under 2 weeks. It won't cost you a single thing. It's only 10 hours long, and I promise you it'll be well worth the money, it'll be well worth your time, and it'll be the best free resource that you can find online. Now, if you get any value out of this video, click that like and subscribe button, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.